We have an important issue today that I wanted to get on the record because I think that it's time for us to talk about the fact that at the present moment 34 states require loans from the federal government to pay their regular unemployment benefits, the most any time since UI system was created in 1935. We're here today to examine how we got to this point and where we go from here. There can be no doubt about the severity of this recession that started in December 2007. And it's a driving force that's depleted the state's unemployment trust funds. In short, higher unemployment means more people need benefits, and that means more money has to be drawn from the trust funds. But that really is only part of the story, and that's really what we're here today to talk about. We will hear today from the GAO, too many states were woefully ill-prepared to weather even a mild recession. Many state UI trust funds had very low reserve levels prior to the start of the recession, so that they had very little cushion to rely on when the need for benefits climbed. Some of the states ignored one of the basic rules of any insurance program, which is to save money in good times to pay out during the hard times. It's in the Bible. If you want the 7 years, the fat years, and the 7 lean years, you can see the story. It's an old maximum, but it simply was ignored politically in this country. GAO informs us the decline in the solvency of the UI system is all about revenue. States' effective tax rates to support UI have declined over time, while the unemployment benefits they have paid have stayed flat relative to wages. So they haven't increased the benefits, but they haven't collected the taxes. That means the weekly UI benefits available today replace no more than a worker's wage in the past, but the unemployment system they depend on is much less solvent. Reduced solvency forces states to raise taxes at the worst possible time during a recession or shortly thereafter. It also creates pressure to cut back on benefits that are already too low to replace even a half of a worker's prior wages. To avoid this same pitfall in the future, we ultimately need to return to a system that is forward funded. A question that will increasingly confront the Congress is whether we can help states suffering from huge deficits in their UI funds while also encouraging them to take steps necessary to ensure a strong and solvent unemployment insurance system in the future. I think the answer is yes, and hopefully today's testimony will provide a roadmap to help us get there. Before I finish my remarks, I want to say a few words about the labor market. Before this Congress and the President Obama enacted the Recovery Act, our economy was hemorrhaging 750,000 jobs a month. In March of this year, our economy gained more than 160,000. This is the first significant increase in more than 3 years. Hopefully, today's unemployment report will show that trend is continuing. The progress shows we have stopped the economic freefall that started under President Bush, but 8 years of failed economic policy has left us with an enormous hole to climb out of. We're really talking about a piece of that today. Since the beginning of the recession, we have lost 8 million jobs when we needed to create nearly 3 million just to keep pace with population growth in this country. Restoring those lost jobs will take time. We're talking about years, not months. It's not going to be over in a week or 6 months or whatever. It's going to be a while. This underscores the importance of maintaining a strong unemployment insurance program. It also means we need to look for additional ways to help long-term unemployed workers, and I expect future hearings to focus on that topic. I now yield to the ranking member, Mr.